Welcome back to another explainer. We're diving straight into things today to demystify the absolute core foundation of business finance. We're talking about the golden rules of accounting. If you've ever found yourself totally tangled up in financial jargon, just wondering how a simple, everyday purchase gets recorded properly, well, this explainer is going to be your roadmap.
Think about it for a second. How do businesses translate the sheer, unfiltered chaos of daily operations, buying paper clips, paying salaries, selling old desks, taking out loans, into perfectly clean, balanced financial records? Without a reliable, universal system, it'd be literally impossible to track every single transaction. You just end up with a massive mountain of receipts and absolutely no idea if you're actually turning a profit. But luckily, accounting has a built-in decoder ring to solve all of this.
So here's our roadmap for today. First, we'll cover the 3 golden rules. Second, real accounts, tangible assets. Third, personal accounts, business relationships. Fourth, nominal accounts, daily operations. Fifth, decoding expenses versus liabilities. And finally, number 6, the bigger financial picture. All right, kicking things off with Section 1, the 3 golden rules.
When we look at our authentic source material, these handwritten notes lay out the foundational matrix of the golden rules. Honestly, you can think of this specific table as the ultimate cheat sheet for accountants. It categorizes the entire financial universe into just 3 simple types of accounts, mapping out exactly what needs to be debited and what needs to be credited.
Let's break that matrix down to make it crystal clear. We've got 3 columns acting as our mental map here. First is the type of account. That's personal, real, or nominal. Next up is the rule for what accounts to be debited. And finally, the rule for what accounts to be credited. Every single time a business does something involving money, it falls right into one of these 3 rows. It's an incredibly elegant, really foolproof system for logging business activities.
Moving right along to Section 2, real accounts, tangible assets. Okay, so the absolute crucial point here is the definition of the real account rule. Debit what comes in, credit what goes out. It really is that simple. This rule governs the tangible things your business can physically touch, stuff like the cash in your register or the furniture in your office. If the business receives it, boom, you debit it. If the business gives it away or it leaves the premises, you credit it. And the source material brilliantly illustrates this rule in action. We have an entry here for a scrap sale voucher. Basically, the business sold some old furniture for cash. So let's apply the rule. What comes in? Cash. Therefore, the cash account is debited. What goes out? The old furniture. So the old furniture account is credited. In accounting shorthand, it reads cash account debit to old furniture. It just perfectly captures the physical flow of those assets. That brings us to Section 3, personal accounts, business relationships. Now, the golden rule for personal accounts is debit the receiver, credit the giver. You're going to use this rule whenever you're dealing with a person, another company, a supplier, or a customer. It's essentially the system's way of tracking who owes the business money and who the business owes money to. Let's look at a super practical example directly from our source notes. Imagine the business purchases office stationery, but they do it on credit. According to the notes, the journal entry requires us to debit the office stationery account and credit the sundry creditor account. Why? Well, because the sundry creditor, the supplier we bought those pens and paper from, is the actual giver of the goods. Since they're the giver and we haven't paid them in cash just yet, we apply the personal account rule and credit their account to show that, yep, we owe them. All right, Section 4, nominal accounts, daily operations. The rule for this one is debit expenses and losses, credit incomes and gains. Guys, this is the absolute engine for tracking your operational performance. Every single time you pay a utility bill, take a loss, or make a sale that generates income, you're using a nominal account to record it. To make this super concrete, let's look back at the source documents. Say you buy a heavy machine. It loses value over time, right? That's depreciation. Since it's a loss of value, our rule tells us the depreciation account is debited. The same goes for operational expenses like our office stationery. Going back to our earlier example, that stationery purchase is an operational expense for the business, so the office stationery account is debited. Next up is Section 5, decoding expenses versus liabilities.
Notice how clearly our source material draws the line here, because this trips a lot of people up. Expenses are the costs of a company's operations, and they can be paid immediately with cash. On the flip side, liabilities are the obligations and debts a company owes. So if a payment is delayed, it creates a liability. Buying printer paper with cash today, that's an expense. But if you buy it on a 30-day invoice, you've incurred an expense and you've created a liability, a debt you have to pay later.
Finally, Section 6, the bigger financial picture. All those daily debits and credits we just spent time talking about, they eventually roll up into much larger categories. For instance, the source defines current assets as things that can be converted into cash within 1 year. Conversely, current liabilities are those obligations you're expected to pay within 1 year, like outstanding rent or maybe unpaid salaries. The golden rules ensure that every single penny is routed exactly where it belongs, so you always know your short-term financial standing. And that beautifully leads us to the ultimate destination, the balance sheet. The source notes define the balance sheet as a statement where we can find all expenses, liabilities, and assets of the business. It's really the master document. If you've been strictly following the golden rules for real, personal, and nominal accounts all year long, your balance sheet is going to be an accurate, perfectly balanced snapshot of your company's true health. Furthermore, accurately tracking those nominal accounts directly determines your bottom line. Just look at this crucial formula from our source notes. It plainly states, net profit equals net total income minus net total expense. If you mess up and fail to correctly debit an expense or credit an income, this whole equation breaks down, and you basically have no idea if your business is actually making money. Which leaves us with this final critical thought. The golden rules aren't just some arbitrary bookkeeping chores. They are literally the grammar of business. When you apply them correctly, they reveal reality. So you have to ask yourself, are your daily debits and credits telling the true, accurate story of your net profit? Because if they aren't, you might just be flying blind. Thanks for joining me on this explainer. Keep those ledgers balanced, and I'll catch you in the next one.